This conference will now be recorded.
Okay, so in Principles 1, we went through a financial accounting theoretical framework where we said that the takeaway from that course was you should be able to prepare income statement, a statement of retained earnings, balance sheet, and a statement of cash flow. Did I make it all? So these are the four statements that you have to be able to prepare. And accounting majors going forward into intermediate, they expect you to be able to prepare these statements. So that's what you have to do on that problem that's due on Thursday. You have to prepare these four financial statements. This was the main takeaway from Principles 1, and we build on this in Principles 2. This is the income statement, which shows sales, cost of goods sold, gross profit, the operating expenses, total expenses, the net income before taxes, then the income taxes, the net income after taxes. And we won't worry about this part of it, but this is what your income statement should look like. Then your statement of retained earnings, we said a simple statement, beginning balance plus the net income less the dividends gives us the ending retained earnings. And then you're being required to do beginning and end of the year balance sheets on the problem that you have. So you do beginning of the year and end of the year. And then the statement of cash flow, four parts: cash flows from operating, operations, investing, financing, and the change in cash flow. Okay. So these are the statements that you'll be preparing. Okay. To prepare those statements, remember, if you remember last time, we started with an accounting equation, and we said everything starts with this equation: assets equal liabilities plus stockholders' equity plus common stock plus retained earnings. And that retained earnings is revenues minus expenses minus dividends. So that's the equation that governs everything that we do. And we expanded that equation to say cash plus other assets equal liabilities plus common stock plus retained earnings. Then we went into a double entry accounting system, and we said that we utilize that double entry accounting system because every time you engage in a financial transaction with someone, you receive something of value, that's the debit. You give something of value, that's the credit. And T account wise, debits are on the left, credits are on the right. So that's the theory behind the double entry system. We have to record what we received and what we gave up. Return this to this equation: assets equal liabilities plus common stock plus retained earnings minus dividends and expenses. The debits for the assets equal the credit for the liabilities, the credits for common stock. The credits for retained earnings can be negative if your company's not doing well. So if it's a credit, the company's doing well. If it's a debit, it's not doing well. Revenues are credits, and of course, expenses and dividends are always debits. So these always have to equal. They have to equal when the journal entry is made. They have to equal when the trial balance is prepared. And we looked at a situation where in double entry accounting, where we purchased an auto, and this shows something about receiving something of value and giving something of value. If you paid cash for the auto, you debit auto 10,000, you credit cash 10,000. You got the auto, you gave up cash. If you sign the note completely to purchase the item, you debit auto 10,000, you credit note payable. That's what you gave up. You got an auto, you gave up a note that you have to pay. And finally, we have that situation where you purchase the auto paying 2,000 down, and you sign the note for the balance. So you debit auto, you credit cash, and you credit notes payable. The debits always have to equal the credits. Okay? The debits always have to equal the credits. Then we went through this accounting cycle, which you're going through. Analyze transactions, make the journal entries, post to the ledger, prepare trial balance, make those wonderful adjusting entries you love so much, do an adjusted trial balance, prepare the financial statements, close the accounts, post-closing trial balance, which is simply the accounts that are left after closing. So this is the accounting cycle that leads us to preparing those financial statements, our major objective. So we said if we just follow these steps, we can get it done. And that first step was making what? Journal entries. And here's a little chart that you're tested on your assessment exam. You can have an asset, a debit increase it, a credit decreases it. The balance of an asset account, if it's not a contra asset, is a debit. For contra assets, a credit increases them, a debit decreases them, the normal balance is a credit. What's an example of a contra account, contra asset account? Anybody?
Repeat that again.
What's an example of a contra asset?
Depreciation expense on auto.
Well, accumulated depreciation is the account, Kayla. So remember, the asset has a debit balance, but we don't impact the cost of the asset. We put it in a credit account, and we'll look at that in a few minutes. Liabilities, credits increase them, debits decrease them. Normal balance is a credit. Common stock, credit, debit, credit. For retained earnings, a credit increases it, a debit decreases it. The normal good balance is a credit, but if your balance, if you balance out of it as a debit, then that means your company is not doing so well. Revenues, credits only. Expenses and dividends, debits only in journal entries and the balance. Then to help you make transactions last time, I told you there were 6 transactions where cash came into business, and cash had to be debited each time. And we're gonna work a little bit on 6 today. So, but we've done these others. So this chart shows you what account you debit and what account you credit when cash comes into the business. When cash goes out of the business, you debit what you bought and you credit cash. And I put 11A in here, purchase of treasury stock. But if you purchase an asset, you debit and credit cash. If you pay a liability, you debit that liability and credit cash. If you pay an expense, credit cash. If you pay dividends, you credit cash. If you refund people on sales, you credit cash. And if you buy some of your stock back that you issue stock, you buy some of it back. You have to be careful with that. We always want to know what the original stock that went into the company was. So we don't debit common stock, we debit treasury stock and credit cash when we buy some of the stock back. Then we get into asset transactions other than cash. And each time it's telling you what you debit and what you credit. Here's that inventory one where you transfer inventory to cost of goods sold. So we always set on a sales, always two entries. That's sale on account 15. Then we have some liability transactions other than cash. So we had these 20 transactions. I've added another one in here, 11A, so it's 21. These are the journal entries that you'll be dealing with on your review problems. Any questions?
No, sir.
Okay. Here's your chart of accounts. See, y'all picked it up so well. And we said you don't create accounts, you got to find an account on here. I think we had to create one once for income taxes, maybe. So you know, you put it in it if an occasion came up like that. But in general, you got to use the accounts here. Make sure when you're making journal entries, you're using the accounts and the account numbers. There are numbers here. Let me go down here. Get those thumbnails out. So you can see when you make journal entry, there's an account number and the account. And we said the reason we did this because I didn't want you to have a journal entry debit asset paid. You got to have in your journal entry something that has a number by it, not asset paid or liability paid or something like that. And then we had this problem that we worked on. And in this problem, we invested $10,000 into the business. And we said that you do what? Debit, cash, credit, common stock. As a type 1, these are the accounts. Any question on how we get this journal entry? Well, we invested $10,000 to start the business. That's how you always start a business. Debit, cash, credit, common stock. The account number for cash is 100. For common stock is 400. And that is a type 1 going back to our types up here. So you go to type 1, debit, cash, credit, common stock. That's the type. It's a type 1. Any questions on making that first journal entry?
No, sir.
Okay. Then we cash receive or car own revenue, debit, cash, credit, sales. That's a type 2. And we're just going down that, we went down the list in that order. Then we collected cash from a customer's own account, type 3, debit, cash, credit account receivable. Receipt of a short-term working loan, we debit cash, credit short-term note payable. Then we purchase supplies paying cash, debit supplies, credit cash. We pay $5,000 on account payable, debit account payable, credit cash. We paid rent expense, debit rent expense, and credit cash. We paid dividends, debit dividends and credit cash. We bought some supplies on account, debit supplies and credit account payable. We made some sales on account. We debit account receivable and credit sales. Are there any questions on any of these entries?
No, sir.
Okay. So y'all better knock that problem out in no time at all. Let's look at another couple of journal entries though. Suppose we got to the end of the counting period. We get to the end of the counting period and it says supplies on hand are $3,000. Supplies on hand are $3,000. What adjusting entry are you going to make?
Say that again.
Okay, we got a supply entry at 5. We bought some. We got a supply entry at 9. We bought some more supplies on account. If ending supplies is $3,000 and I tell you to make an adjusting entry, what would that entry be? I can hear you, Dawkins and Williams.
Would it be the supplies expense?
We're going to debit supplies expense. Thank you, Amber.
Do you need the number for it?
Should be 3,000.
Okay. What we're going to credit, and then we get to the amount. We don't worry about the number right now. What we're going to credit?
Supplies.
We're going to credit supplies because they're gone. We had in the supplies account 1,000 and 8,000. We had in our bank account $9,000. At the end of the period, we only got $3,000. How much did we spend?
6,000.
6,000.
6,000.
Any questions on that? It's not the amount, the journal entry is what we spent. And once we make this journal entry, we're going to be at 3,000 in the account. Suppose we paid back 1,000 of this common stock. That is, we gave that, we had some dissident team members and we said, you can have your money back. What journal entry would we make?
Wouldn't we it would be a credit to cash and a debit to common stock?
Nah, you must be eating. We're going to debit treasury stock. And we're going to credit cash.
Wait. But you said, why is it treasury stock again? Did I miss that part of the lecture?
You're really not supposed to take the money out of the company. So if you do that, you can't just reduce the common stock. The common stock's going to take it 10,000, stay at 10,000. Then you're going to have an account treasury stock, 1,000, which shows you bought somebody out the company. Well, you're not supposed to be doing this, and you'd have to have retained earnings and stuff like this, because the 10,000 is your legal capital. You're supposed to keep a minimum of 10,000 in the company, and so we're gonna show that, and then you're gonna have to have some cash and do some other things. So the bottom line is you got to put it in treasury stock, so everybody know that's what you did. Okay, you don't debit common stock. So this tells us we had 10 shareholders who paid $1,000 each, and now we have one who left. That information has to be out there. Any questions? Okay. Time to buy an automobile. How much did we have that auto costing me for? $10,000. Okay. Buy an automobile costing $10,000. We paid cash down to $2,000. And therefore, we will sign a note payable for the balance, right?
Yes.
8,000. Okay. Need some more lines in here. All right, all right, so while I'm getting this up here, suppose the automobile has a full year life, 2,000 salvage, and we're using double declining balance depreciation. What's going to be the adjusting entry for depreciation? We have an automobile that costs $4,000, $10,000, has a $4,000 life, have a full year life, 2,000 salvage, and we're using double declining balance. What is going to be our estimated depreciation?
Ooh, a little rusty. You said it was a $2,000 salvage, right?
Hmm?
Double declining. What we
Double
doing?
declining balance. I don't hear you, Dawkins.
She working on it. That's why I'm talking right now.
So when we calculate depreciation, we know that we do what?
Well,
Double
you
declining
subtract the salvage value from the original value.
right? And we're going to divide that by what? 4 to get us a double declining balance rate of what?
50.
50%. So when we get ready to make this entry, we're going to what? Debit what? Depreciation expense. And credit what? Accumulated. See why I can't let y'all rest? Y'all lose the game. We ignore salary, so we take 50% of this 10,000. And so the depreciation is how much? $5,000. That is, we bought a car, but it's going down in value. So we had it go down a whole lot. Okay.
Dr. Boyd, could you please kind of go back over the reason why it says 200%? Could you kind of go back over that again, just to clarify?
Okay. When we calculate depreciation, we go straight line. We went straight line. It will be 100% divided by the life of 4 years, and you would come up with a rate of 25%. But when we use double declining balance, because we want to write off a lot more, our rate becomes 50%, and we ignore salvage, other costs. So we just simply multiply 50% times the octo. We'll go back over this next time, but go ahead, you got your primers and everything. Go ahead and review depreciation a little bit, and we'll look. I want to cover a couple of other things, go get through the cycle, then we'll repeat this next time. Okay? There's a lecture in there on depreciation. There's primer information on it. We will go back on it. But the key thing is that these are the accounts. We got to do one other thing so we can finish up today. Suppose that you sell the car at the end of this period. You sell a car for $6,000. Okay? So you don't keep the car. You sell the car for $6,000. What you gonna do now?
Repeat that one more time.
We sold the car for $6,000. Well, if we sold it for $6,000, we know we're gonna debit cash for what?
$6,000.
Okay. We sold an automobile. The automobile costs us $10,000. So we're gonna credit the auto. For $10,000. Is this equation balanced?
No, we gotta account for depreciation.
Okay. So we took depreciation of $5,000. So we're gonna debit. It's got a credit balance, and so we got the debit accumulate depreciation. For the 5,000. We're still not balanced, Kayla. So we'd have, this car is now worth about 5,000, 10,000 minus 5, we got 6,400. And so we had a gain on the sale auto. So it's gain on
That's on
the
a chart of accounts, right?
Wait, what?
That's on a chart of accounts, right?
Correct? That gain, yeah, at the bottom.
So the gain on the sale would be the difference
But between the two, like the 1,000?
Yep.
Okay.
Solid. So remember we
So
talked
you
about
only get like a gain if you sell it for more than what it's worth.
gain is going to be whatever make this equation balance. You got to put down the auto, you got to put down the cash, got to put down the accumulated depreciation, and the difference, whatever, if it's over here, uh, in this case, it was 11, so we had a gain of 1,000. If we only got 3,000 for the car, delete it, and then we'd have a loss now of $2,000. So you either have a gain or a loss when you sell these assets. I think that's type 6. So just going over that for you. Okay. Now we know that once we have a transaction, once we make a journal entry, what we got to do next?
P accounts.
Post them to the ledger. Then we do what next? Prepare trial balance to make sure everything is in balance. Then prepare that income statement that we talked about.
And the ending journal entries, whatever.
Yeah, we'll get that too. We prepare the statement of retained earnings. We prepare the balance sheet. And your problem, you'll be doing beginning and ending balance sheet. Here we talk about the functions of the financial statements. We have the balance sheet at the beginning of the year. The income statement tells us what happened in terms of income. The cash flow statement tells us what happened in terms of cash. The statement of retained earnings tells us how much of the income that we kept in the business, and the balance sheet tells us where we are now. Okay. So, in course content are 4 problems. Continuing students, you've been assigned problem 1, 2, or 3. You take that problem that you were assigned and you submit it to me. For new students, you don't have to submit yours, even though it says it's due. You don't have to submit your problem 4, until next Tuesday. So then, of course, only 2/3 or so of your grade is on what you turn in. Then you have to present in class so you can explain this to students about what you did and how you get there. So
I have a question.
Yes.
So for the new students, you said the only thing that we have to do is number 4, and it's due next Tuesday, right?
Correct.
Okay, thank you.
Mayo, can you do it already?
I mean, I can try with the notes and what you've been talking about. I think I can do it.
Okay, sounds good.
Okay.
So that's somebody you want on your team. Talk and ask.
Hello, excuse me.
Do what they want to do. Yes, Mr. Howard.
Where are these problems? Where are these problems? Are they in the
They're
book?
in assignments.
Or they
So go to
yes, they're in assignments.
Go to Blackboard and look at assignments.
So the class end at 12:15, right?
We're like a Baptist church. We end when we get through.
No, class in at 12:15.
Wow.
I'm not gonna lie, that was really funny.
Okay, Professor Boyd, one last question for me.
Let's
So
go.
we gotta have new students, or we can just have like 4 old students
What did
in
I
the class.
say? What did I say?
Do we have to follow?
Oh, see, I thought it was supposed to. That's what I'm
You got
asking.
to follow what I told you. 2 new students and 2 old students. That's what you got to
Okay,
do.
thank you for clarification. That's all I needed to know. No back talk. That's all I
Right.
needed.
Good. That's
Okay.
required.
I got a question.
Yes.
Under the assignments that for the continuing students that's due on Thursday, which one are we supposed to do? Because there's 1, 2, 3, and 4 of the review problems.
There should be a spreadsheet in there which has your T number and the problem you assigned.
Okay. All right.
And that's how you get your, that's how I'll probably send out exams and everything this year. It's much easier for me if I just do it ahead of time, then I'll put it in assignments like that rather than emailing you, since some people had trouble with the email. Everybody can get in Blackboard, correct?
Yes.
Yes, I
Yes.
I have to
Yes.
sign in because I was having issues earlier this morning.
You were, Deja.
So
Yes, I was.
this first assignment that we're doing is an individual thing, right? It's like,
Individual thing.
okay.
So I'll leave this up so you all can begin to talk, put your screens on, begin to talk, and begin to create groups. So it might be good to look at each other a little bit one time, so you're presentable. And Cameron, you've been very quiet today.
I just been listening.
That means I'm gonna call on you next class period. Just letting you know.
Okay. So I can every class experience.
So what?
I said okay.
Okay. So what? Why don't you all spend a few minutes now getting your teams done? You know, letting Kayla and Dawkins know who's going to be on the team, and then and then you all can begin to talk and tell them about the class, how I teach, what's involved, what I expect, how everybody's going to do so well, make nothing but A's and B's. Let's see.